distinguished guests, ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh. A very good morning to all of you. I would like to say sorry, sincerely apologize for being late. I was caught in the worst traffic jam ever. But it gives me great pleasure to participate in this conference. I would like to thank Israel for inviting me to speak to you this morning. There is indeed still an insufficient level of understanding on the part of the stakeholders of the Islamic financial service industry of the various types of risk exposures that may arise from a breach of Shari'ah rules and principles by institutions offering Islamic financial services. And I wish to share with you this morning some of my thoughts on this important issue, which I think is really becoming important. I was given to understand that the aim of the conference is to deliberate on Sharia compliance risk, particularly in relation to fund management and structured products, and also to elaborate on Sharia governance models as applied in the market, and to examine how effective are these models in managing Sharia compliance risk. Indeed, if we observe closely, we will notice that there have been different regulatory and supervisory approaches to Sharia governance amongst institutions that offer Islamic financial service in different jurisdictions. This effectively resulted in a divergence rather than convergence of practices regarding Sharia governance systems. For example, at one extreme, some supervisory authorities may decide that their responsibility of supervising governance does not extend to the particular Sharia governance structure adopted by any of these institutions, as they are concerned only with the need for institutions that offer Islamic financial service to have an effective system for managing reputation risk related to Sharia governance. Therefore, they permit these institutions to decide for themselves what kind of Sharia governance systems to adopt. The market, in other words, is left to determine freely which system lends sufficient credibility to the products and services that each of these institutions offers. On the other hand, some other supervisory authorities are concerned with market deficiencies and the need for client protection. Therefore, they require that each of these institutions should have a properly functioning Sharia governance system in place and will seek reassurance that this is the case. They also, through a general consultative process, untied to any specific Sharia board, issue circulars and directives relating to Sharia compliant products such as sukuk, etc. and so on. Few other supervisory authorities seem to take the view that Sharia boards have a significant role to play in monitoring the financial health of institutions that offer Islamic financial services, similar to other professional advisors, such as the lawyers, accountants, and auditors. They then impose a requirement that each institution that offers Islamic financial services must have a certain minimum number of members of Sharia boards, who must also meet certain fit and proper criteria similar to the assurance sought when banks are appointing members of their board of directors. At the other extreme, some supervisory authorities have their own Shari'ah board that works together with them in issuing standardized Shari'ah pronouncements, as well as aligning relevant policy and regulatory frameworks with the Shari'ah. Although they may be known by different names such as National Shari'ah Advisory Council, National Fatwa Council, Higher Shari'ah Board, etc., their functions are very much similar, i.e. to become the highest body issuing Shari'ah pronouncement for the industry in the country. Some of the supervisory authorities have even gone one step further, whereby they prohibit members of the National Shari'ah panel from sitting on Shari'ah boards of the market players. In addition, each member of a market player's Shari'ah board is restricted in terms of the number of Shari'ah boards of other market players on which he or she can serve. Now, this restriction is intended not only to minimize potential conflicts of interest and to maintain an appropriate firewall to preserve confidentiality, but also, perhaps more importantly, to ensure that the members of a Shari'ah board can devote adequate time and effort to each of the institutions that offer Islamic financial services that they serve. In 2007, the IFSB commissioned an international firm to conduct, among other surveys, a survey on the different Shari'ah board practices. A survey which has since become a chapter in a book published by the IFSB entitled Islamic Finance Global Legal Issues and Challenges, highlights very broad diversities in Shari'ah board practices, implying that much more needs to be done if we are to promote effectively convergence of Shari'ah governance systems. Now, as you may know, since its inauguration in 2002, the IFSB as an international standard-setting body for the prudential framework of the Islamic financial services industry has undertaken various initiatives that address the specificities of this industry, its risks and Sharia compliance. This has been done by developing a cross-sectoral approach to the regulation of and supervision of the institutions that offer Islamic financial services that broadly encompass banking, capital market, and careful sectors. In this respect, the IFSB has always recognized Sharia convergence or governance as a fundamental specificity that greatly affects the soundness and stability of an institution that offers Islamic financial service. And indeed, it has been a recurring theme in all our earlier standards, including those on capital adequacy, risk management, and corporate governance, each time from a different technical perspective. In view of the rapid growth which we are now witnessing in this industry, and following the increasingly challenging business environment as a result of the current global financial crisis, I believe it has become more crucial for all stakeholders of the industry to take a comprehensive and holistic view on issues at hand, including improving our understanding of Sharia compliance risks and strengthening our Sharia governance approaches. In all its work, the IFSB has placed a very strong emphasis on enhancing the soundness, the risk management, and prudential framework for the institutions that offer Islamic financial services, in particular with regard to compliance with the Shari'ah. Just to summarize some of these initiatives, as early as first standard, the guiding principles of risk management, which was issued in December 2005, we've highlighted and articulated various risk factors that may arise from structures and processes adopted by the institutions that offer Islamic financial services in ensuring their adherence to Shari'ah. Among others, IFSB risk management standard points out the need for these institutions to develop and implement credit risk mitigation techniques, exit strategies, and liquidity management tools that comply with Shari'ah, and to establish adequate systems and controls such as a Shari'ah board to advise on and supervise its Shari'ah compliance process. In addition, the risk management standard also recommends that supervisory authority should consider developing Shari'ah guidelines or minimum documentation in respect of agreements between the institutions that offer Islamic financial services and counterparties for the financing instruments used in their jurisdictions, as well as satisfying themselves that these institutions have adequate Shari'ah compliance mechanism in place. Now, these include a well-defined and adequately qualified and satisfied organizational structure, clear lines of authority and accountability, and policies and procedures pertaining to the approval of products and activities. In our second standard, the Capital Adequacy Standard, which was also issued in December 2005, we emphasize that Shari'ah compliance risk should be considered as a type of operational risk facing the institutions that offer Islamic financial services, which can lead to non-recognition of income and resultant losses. Hence, in addition to setting out the appropriate capital adequacy calculations to be applied by these institutions, the capital adequacy standard also noted that supervisory authorities should, among other things, have the discretion to impose a higher capital charge as they may deem fit to cater for the Shari'ah compliance risk of a particular institution that offers Islamic financial service. Now, our corporate governance standard, which was issued in December 2006, considers Shari'ah governance as an integral part of sound governance in institutions that offer the service. The standard makes several groundbreaking recommendations on best practices. For example, by calling for a comprehensive Shari'ah governance structure and process covering both ex ante and ex post aspects, i.e., before the financial products are offered to the market and during continuous assessment thereafter. The standard also recommends enhancing the disclosure and transparency in relation to areas such as issuance of Shari'ah resolutions and Shari'ah compliance reporting. in our governance standard for Islamic collective investment schemes, which we issued early this year in January, the standard highlights that ex-ante activities such as portfolio screening, as well as ex-post activities such as purification of income or tanqiyah should form a critical part of our effective Sharia risk management and governance system. Now, our latest standard on Sharia governance system, which just completed its 5 months public consultation period last May, will, inshallah, be adopted by the Council of the IFSB in November this year. It sets out several recommended best practices aimed at ensuring the competence, safeguarding the independence, observing the confidentiality, and promoting consistency in Sharia governance structures and processes. Now, without a doubt, amidst all our concerns regarding Sharia compliance risks and Sharia governance, Sharia scholars who sit as Sharia advisors and members of Sharia boards play a crucial role in ensuring effective Sharia compliance and retaining public confidence. However, let us not overlook the fact that actually every stakeholder in this industry, including the clients, management, shareholders, and the supervisory authorities, should also play a part in sharing this responsibility. Therefore, while Sharia boards are expected to play a leading role in ensuring sound Sharia governance, it is also reasonable to expect other organs of governance in any institution that offers Islamic financial services to share in upholding the Sharia governance system by executing their functions well and recognizing the importance of complementing the work of the Sharia boards. Three recent examples in which certain Sharia pronouncements or views have, albeit maybe unintentionally, exposed institutions that offer Islamic financial services to huge operational risks, including fiduciary risk, reputational risk, legal risks, and risk of financial loss, definitely serve as a wake-up call to all that Sharia governance or the Sharia compliance risk can never be underestimated. First of these examples is the Sharia pronouncement that a large portion of the sukuk available in the market today actually do not comply with the Sharia. The second example is the High Court decision in Malaysia, which ruled that certain Islamic home financing structures do not qualify as Islamic. And the third example, a recent Sharia pronouncement by the International Body of Jurists, which ruled that certain liquidity management products used by institutions that offer Islamic financial services were not compliant with the Sharia. Now, in all three cases, the market was unprepared for such news and was generally kept in the dark as to how market player should react or respond to the situation. Surely, the industry needs a Sharia governance system that is reliable, credible, and effective. Therefore, Sharia scholars and other stakeholders in the industry, especially the regulatory and supervisory authorities, need to work together more closely to address one another's needs and concerns. It's also worth noting that in the current gloomy economic climate resulting from the recent global financial crisis, even institutions that offer Islamic financial services are not spared, and a small number are already forced to commence restructuring schemes to turn around their financial situation. As this industry has never faced such a grave situation before and generally lacks appropriate crisis management tools that can be considered Sharia compliant, there is an urgent need for the industry stakeholders to collaborate in developing Sharia compliant solutions that can assist institutions that offer Islamic financial services overcome these dangers. Now, in the spirit of sharing responsibility and playing a part in promoting sound Sharia risk management and governance, the IFSB is committed to continue pursuing further research and exploring the possibility of developing additional guidance in relation to Sharia risk management and governance. In addition to earlier initiatives, inshallah, next month we will be holding a special technical seminar on Sharia and legal operandi of takaful and retakaful in collaboration with the Islamic Development Bank. In closing, I look forward to your deliberations and contributions. And I'm sure that constructive ideas which emerge from conferences such as this one will encourage stronger consensus and spread better awareness so as to promote a more robust and effective Sharia risk management and governance framework for the Islamic financial industry, service industry. Thank you very much for your attention.